I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org. I'm joined today by Theresa Whitmarsh, who is the Executive Director of the Washington State Investment Board, one of the United States' leading institutional investors, managing nearly $165 billion of state pension, insurance, and other assets. And importantly to us, Theresa has been a member of the board of FCLT Global since our founding. So welcome, Theresa, and thank you for joining us today.
Thank you.
So let's start with governance. Governance is such an important question for how asset owners manage to focus on the long term. And that's something we've worked on a lot at FCLT Global. But you have a governance structure that has shown an ability to keep an eye on the long term over time. Can you talk a little bit about how your board works and how you manage to keep a big public fund board focused on the long term?
Sure, absolutely. And I think just to start off, good governance, as we all know for our study of corporate governance, it's not by chance. It really takes advanced engineering. And you think about it, when you step into and drive a really well-engineered car, you appreciate it. You feel it. You appreciate the care that went into its assemblage. Oftentimes, especially for me, without understanding the engineering that occurred long before we got into the car. So I kind of think it's similar at the WSIB. We have the good fortune to be driving a well-engineered machine. They structured our organization with three real strong principles. One is they created a balanced representation of beneficiaries, elected officials, worker representatives, and importantly, investment experts in addition to the beneficiary reps. They also established the board with a high degree of independence from the partisan political and policymaking process. There's no single appointing authority that controls the board, and it's set in statute as an independent body. And then finally, we have a very clear mission, similar to other public fund missions, but it's in statute, which is to focus on maximizing return at a prudent level of risk. But like any complex engineered system, it also needs routine maintenance. And so the structure and statutory independence of the board really helps, but staying focused on the long term, I think, is more than structure. It has to be built into the DNA of the organization. For instance, we've adopted investment beliefs that frame our time horizon as long term. We have capital market assumptions, which, as you know, are the essential building blocks of our asset allocation. And our capital market assumptions look out at least 15 years. Another thing we do is we report performance. Certainly we report it in shorter time periods, 1, 3, 5, 10, but we also report performance on a 20-year time period and a since inception time period. We don't focus on volatility as a primary risk measure with the board. In fact, if anything, we caution its use as a risk measure, though we certainly track it. But volatility, which is what most people pay attention to in the markets, is not a good measure if you're a long horizon investor. And I think one of the things we also do is our board members, especially those who don't come onto our board with any investment expertise, they can get really concerned about short-term market movements. And so we spend a lot of time onboarding and educating those members so that they learn to not worry, basically. And we supply them with talking points, tools that allow them to go talk to their beneficiary groups. And interestingly enough, we had a board member representing the retirees called me up one day. She'd only been on the board a few weeks. And she said, "How much did we lose in the markets today?" And that was because her beneficiaries, the people she represented, had come to her and asked. It was in one of those, major dramatic days. And I just told her, first of all, I'm not going to give you the number. we don't track it like that. But then, and again, supplied her with the tools she did need to talk with the beneficiary group. So I think it's governance structure, it's investment beliefs, it's time horizon when you're building your asset allocation, and then it's constantly reinforcing the message with those members as they come on. And then over time, those board members themselves become advocates for long-termism.
That makes a lot of sense. I know that your board has been invested in private equity for a long time, one of the earlier investors in the private equity market, which obviously requires a bit of a long-term mindset. So you have an interesting portfolio, which is largely a mix of indexed equities on the public side, and then very large allocations to private equity, other sorts of illiquid assets, such as real estate. On the other side, can you talk about the governance of those long-term assets and how those that governance supports your ability to do that, or vice versa?
Sure. Our asset allocation does go back to our long horizon view, and it's also coupled with where in our governance structure we think we can add alpha. So our pooled retirement plan portfolio, we call it the commingled trust fund, which is about 127 billion of our assets under management. Half of that fund is in private assets. So 23% private equity, 18% private real estate, and 7% tangibles, which are actual physical assets such as timberland, agriculture, and infrastructure. Our history with private assets goes back to our founding. The first WSIB executive director back in 1981 had strong relationships and experience with what at that time was the fledgling venture community. So our first private equity investment was in the early 80s, and our first private real estate investment was shortly after that. So the board developed expertise early on in these asset types and became comfortable with a long horizon perspective from the early days. So as to our decision to be primarily passive in public equities, there are two explanations. One is liquidity, and that's important when half the portfolio is illiquid. But we also don't think we've had a particular advantage in public markets like we do in private markets, nor do we think it's as attainable over long periods for active management to outperform passive. So we've made our active bets where we can outperform. But that said, we, like many institutional investors, we are looking at our passive active mix. We are entirely passive developed markets. We are active in some emerging markets. But there's a lot of talk about, are we at a tipping point where active is going to now start outperforming passive? And certainly COVID has proven there's huge opportunities when you get this kind of market disruption in active. So we're still studying that.
So let's talk about COVID then. What impact has COVID-19 had on your investment strategy, and how have you taken that either into account now, or as you said, you've got these long-term 15-year capital markets assumptions, as you look forward, how do you see the impact of the pandemic lingering on both the economy and the investment world in particular?
I wish we had a crystal ball, but we don't. I think to really be honest, we're still trying to figure this out. 2020 was like a 100-year storm. We experienced simultaneously a pandemic, a recession, a wave of mass social protest and unrest, and certainly a landmark presidential election. And forecasting is always difficult. Markets are always complex and hard to figure out, but I think they're even more complex and hard to figure out right now. So we're only beginning to estimate the longer range implications of what we're experiencing. And I think the first step is to be really humble and admit that we don't know how this will all shake out. We spend a lot of time with our board discussing this. But the economic debate includes some who see very encouraging potential in the combination of successful vaccines, pent-up consumer demand, enormous fiscal stimulus, lower interest rates. On the other hand, others are less rosy in their view because they see 11 million people out of work, entire industries disrupted. No one knows for sure if they'll come back. Think about travel, think about hospitality, think about retail. There's been fundamental shifts and changes in how people behave and how much of that will be long lasting. So we're still sorting through it. Closer to home, it's more difficult to do due diligence. It's just, there's nothing like getting to know someone personally and being in their offices and seeing their culture and how an organization functions. So it's finding new opportunities will take longer in this environment. I think like every employer, we're facing the workplace impacts, and we're trying to think about how we manage in an ongoing way with more remote working. It creates both opportunity and challenges. We think we'll probably have a hybrid model of working where people will continue to work at home part-time in the office. We'll need more convening opportunities for staff to maintain that social fabric. So like every employer, we're sorting through all of that. And then I think just cultural impacts, both on communities and in the workplace. A virtual environment can only take you so far in a relationship. So we're struggling like with all of those things, just like everyone else.
Yeah, we're all trying to figure that out. And what does a hybrid model really look like? And how does that, when and how? So that, we'll all experiment. The other thing that you mentioned was, obviously a lot happened in 2020, but one of them was, as you mentioned, some of the social justice issues. So as a public plan, how do you think about both? Obviously, you said earlier that your in statute, your mission is to generate return, but at the same time, you have a large number of constituents who I'm sure care about social justice issues, care about climate issues. How do you and your board think about taking into account issues beyond financial return when you think about your investment decisions?
Sure. So as a public trust fund, we are absolutely bound by fiduciary duty. And the statute requires us to work exclusively for the financial interests of our beneficiaries. So our mission at its core is very financial. That said, if you're a long horizon investor, you also must take into account the big systemic issues that impact the markets and the economy. And this is where I think long-term investing in ESG or externalities converge. So we think any investor with a long-term horizon has to be asking questions about climate change, has to be asking human capital management questions as we see social unrest, because those things will ultimately impact corporate profits and corporate, the concept of an authorizing environment. People are demanding more and more of the companies they invest in. Consumers are demanding more responsible behavior from companies. So I think anyone who, either an investor or a corporation who's trying to create value, if they ignore these things, they're going to ultimately lose value in the marketplace. So we don't really see it as an either or. We really think there's a fiduciary tension. There'll always be unknowns that play out over the long term. At the same time, we need to act on behalf of our plan participants with what we do know and what we can influence.
So one of the things that I know about you've been an outspoken proponent of diversity on your own team and among your managers for years, and have thought a lot about that issue, particularly obviously in the investment business, which is often not particularly diverse. And I know with us, you participated recently in a session on the diversity of private equity backed portfolio company boards, which is an interesting sort of microcosm of this issue. But why do you think diversity is so important for long-term value creation? And what do we need to do to get past talking about this and just get it done?
Sure, I'm into the let's just get it done mode, definitely. Diversity's proven, it's well researched as a principle for investors. If diversification is, always often said the only free lunch in investing, why in the world then wouldn't diversity of opinion, of thought, of background, of human capital, why wouldn't it be as important? So I think the wider our net for attracting and retaining talent, the better chance we have of capturing insights and knowledge and differentiated skill sets. I think one of the things I have been quoted saying is when I was in Davos and looked around the room and saw essentially 90 men in the private equity industry, and I was the only female in the room other than the staff supporting the event. And they were talking about the fight for or the competition for good talent. And my observation was, well, when you exclude more than 50% of the workforce from your talent pool, no wonder you're in a fight for talent. And I just think that was sort of an aha moment for me, which made me realize I have an obligation to speak out on this. We have huge investments in private equity industry, and it at that time was a real laggard in terms of particular gender diversity, but other types of diversity as well. And I think what we know now about what diversity does for decision making. It's proven. It shows that the more diverse viewpoints you bring to a decision process, the better decision you're going to make. I just felt like we can't ignore this. We need to demand better performance. What was interesting is early on, because we have done very well in private equity as an investor, people were saying, well, you're already making good returns. And I think, well, what additional premium would we get on those returns if there was a diverse approach? So the other reason that the private equity industry attracted me in terms of really focusing on this is they are by nature people who solve business problems, solve complex business problems. So it seemed like a good group to tackle diversity. And I think there's been really promising developments in that area.
Yeah, I think they once they get going, they sort of get it done. So that's really helpful. That's exciting.
Maybe a further comment on boards, why boards is an important focus. That sets the tone at the top. So the board is the one that management answers to. And if the board starts asking questions, if the board if there's a diverse board, first of all, they're going to make better decisions as a board, but they're also going to set a tone for management that there should be diversity within the organization. And I think that spreads out to having a much larger impact than just in the boardroom, which I think is really important.
And that circles us back a little bit to where we started, which is your governance and the importance of your governance to your organization. And clearly that is so important to the governance of any organization. So as you look forward and try to, you said you don't have a crystal ball, but as you try to think about where the investment business is going over the next few years, how the asset owners are changing, there's clearly been a group of, I would say, more forward-looking asset owners, perhaps some of the ones that you were talking with in some of the forums that you're involved in. Do you think that the asset owner community in general is going in that direction, or is there what advice would you give to your perhaps smaller counterparts or people who haven't quite thought as much about these issues of either diversity affecting their portfolio or climate change affecting their portfolio or other future oriented issues? How do they start to take that into account if they haven't had the governance set up, since the beginning and has been as fortunate as WSIB has is to have that set up well? What advice do you give to the others?
Well, I think a lot of people are moving more and more into passive investing, which is, of course, a long horizon strategy simply because return is cost effective and the returns have been really good. So I think that one's really easy. That's an easy thing for a small fund to do. Private markets are tougher. They're tougher to get into. They're tougher to build expertise in. But I still think doing some of the things WSIB does, focusing on returns over the long term, incentivizing your staff, not on a short-term basis. Compensation structure, we all know, really matters. And in a public fund environment, it matters just as much as in a private sector environment. So looking at that, looking at your investment beliefs, having strong investment beliefs that are focused on a long horizon, having your capital market assumptions that go into your asset allocation be focused on the long term. And then finally, I think, one of my mantras as a long horizon investor is this too shall pass. I think temperament is really important in this business. There's a lot of talk right now about resilience, corporate resilience, institutional investor resilience. And a lot of that comes with patience and experience. And so I think, we are, while we invest in the present, and today feels really chaotic, we are making decisions for the future. And we have to be humbled by how challenging that is. But we also know from past crises that we've survived that staying focused on the long term does yield a better outcome over time. So I think, again, when I think back on board governance, a well-equipped board with the data, the research, the talking points, the rationale for staying long-term can resist some of the short-term pressures that are put on by politicians, by other stakeholders. So I think it's very doable, but I do think it takes a combination of resilient and patient board members along with staff that are incentivized to think long-term.
I think that you've given us a very good sort of checklist there, governance that's focused on the long-term, incentives that are focused on the long-term, investment beliefs and capital markets assumptions, reporting that is emphasizing the long-term, not as your board member once asked you, how did we do today? And the temperament, maybe I'll call it the anti-GameStop temperament. So it's the opposite of what we see in most of the media.
It's interesting because I think traders are supposed to have sort of nerves of steel. I think it takes way more strength to resist short-term movement, and I think it takes nerves of steel to be a long horizon investor. I really do.
Well, I think you've shown us over many years, you do have the nerves of steel and you do have that patience and have been able to lead that organization. And I'm sure that in the years to come, people will refer to you as you have referred back to all of your predecessors as laying the groundwork for them to be long-term. So thank you for your time and your insights and for all that you do for FCLT Global. We're very grateful, and this has been a really very informative and interesting conversation today. So thank you.
Thank you for asking me. It's been a privilege to share.
Thanks for listening to today's episode of Going Long with FCLT Global. Be sure to hit subscribe to get new episodes every other Monday. To learn more, visit our website at fcltglobal.org.